Welcome to the next part of the Wyckoff theory, which is about the market phases. Now, what Wyckoff is telling us is just another name for buying low, selling high. So he describes the theory about the accumulation phase, which is when price started to consolidate in a range. And the expectation is that if the price will do something like that, is that it will suddenly start rallying to the upside, which we call markup phase. So this is the markup phase. This here is the accumulation phase. And then after the price went that crazy to the upside, it will start again kind of in range, and then it will create that distribution phase, which will lead into a mark down phase. Okay, so mark down and mark up phase. So let me just show it to you here. This is what the market did. It's this thing over here. It's oversold. This is what a price is entering an accumulation area or accumulation zone. Then price is starting that strong mark up phase. Afterwards, it will be overbought, so the price is too high. Investors are not interested in joining the market anymore, so the price will then drop to the downside due to supply is greater than demand. Boom, we have a markdown phase. So you can read everything over here, so it's super nice described on this website. But I'm going to explain it to you how we're going to use it, because the thing is right now about these accumulation and distribution phases that we have over here is that the market are super manipulated. So that one would be too easy, right? Price just doing this, and you're just buying here, you're buying here, you're buying here, and again, and then price will go up higher. Well, in reality, it will look completely different. The price will make here crazy movements to the downside, then to the upside, then again to the downside, and you have absolutely no clue why the market did that. But if you understand what an accumulation phase really is about, then you've already studied this thing. Now, let me explain it to you what this thing right now here is, because this thing is just describing how institutions are manipulating the price, so how they are generating an accumulation phase. And I'm going to explain to you right now how an institution is working. So we will make here an example on an institution who gets the email from his boss, or the boss comes to the trader. So institution works like that. It's a big team, right? And there is the trader, there is the risk analyst, and many more people. And the boss, okay, will say to the trader, hey, we need to buy right now. Let's say this is GBP/AUD, okay? It's GBP/AUD. And the boss says to the trader, please buy it. Now, the thing is, if an institution would just press the buy button, price would go like that. So they can do this. But the thing is, if they would push the price like that to the upside, they would be in loss. Okay? Because an institution makes money by trapping people. And if a market will just spike to one side, you will not make the biggest outcome that's possible. It is much better for an institution if they are taking out people on both sides. So people who are buying and people who are selling. And this is actually the idea of the accumulation and also of the distribution phase. Okay, so this is the distribution phase, this is the accumulation phase. So the accumulation phase is actually when the price is, like we already discussed, if it's here, if it's oversold, so price is then about to go up higher. Okay, now we will make the distribution, because me personally I like short more, so this is my favorite, but everything works completely the same for every single, if it's distribution or accumulation. So like I said, the boss says to the trader, okay, we have GBPOD, I want you to sell it. And his job is actually in the first place to bring the price at the end here. That's the first thing that he needs to be successful. I promise you that they will not always reach that. Sometimes their distribution phases will fail. Why? Because another institution will come and will just boom push through their distribution phase. This is why hedge funds, why institutions and so on, they can make big losses as well if they are doing something wrong. But everything has changed from time to time. Okay, so this what I'm explaining right now is when people really traded it. Hedge funds are still trading by themselves, of course, but majority of the institutions, they are just working with algorithm, and the algorithm works with the same principles like the real trader. Okay, the job is to get out everybody out of the market, and that the institution at the end will make crazy profit. Okay, that's the theory behind it, behind the accumulation and distribution phases. All right, now let's get it right into the example, explaining you right now what the task is. So the task is for the trader, for the algorithm, to put 10,000, okay, 10,000 of lot short. This is the goal. We would like to get 10,000 short positions, a lot. That's the task. So let's put it here. Okay, what will the market do first? Well, we have a few steps, and step number 1 is here at the PSY. Here the bank will start, and he will open here 1,000 lot. Okay, this is the first position that the bank or the algorithm will take, 1,000 short position. What the market will do here is, what gave us a reaction, right? Price is giving a reaction, and then price is moving up higher. Do you think that this is good for the institution, or is this bad for the institution? It's a good question, right? This is very good for the institution. Why? Well, if the market doesn't have enough liquidity at this point where the bank will put 1,000 lot into shorts, and the market from here will not go up higher after a quick reaction, then it means that there is not enough liquidity, which will mean that the price will then drop like this. And this is not what an institution would like to do. What an institution would like to do is actually collecting here liquidity and not just pushing or dropping the price to the downside for no reason. Okay, so they're always accumulating and distributing the prices in order for them to make crazy profit. So for them, this is super important. This step was super important because this is how they recognize if the market has enough liquidity or not. Okay, so we have right now only 9,000 lot left to put it into the market, because that is our task, to put 10,000 lot on short and to be, of course, at the end profitable, so that the market will really drop down. Then let's get it started. Let's get to the next step actually, and this is the BC. Okay, the buying climax. Here, the institution will add additional position. Let's say he's opening up here 500 lot. Okay, the bank is just testing. Okay, bank is right now not making any kind of big decision. Bank just is constantly adding right now their positions that they need to add, and this is where they put here 500 lots. And of course the pressure from here is still here, right? Because you have in total 1,500 lots currently running, and price started to drop. Okay, what do you think will the bank do here at the AR? What do you think? Well, actually nothing. This is why this phase is also called automatic reaction, which means that the market here is still bullish. The market is still bullish. So the institution doesn't need to put from here the price up higher. So they don't need to buy it in order to bring the price here, because they would like to bring the price up there, but they don't need it because they have already enough liquidity. Okay, this is here where liquidity is generated. If you have an uptrend, liquidity is generated and the price will just pump up higher. So the market will have at this phase enough buyers, enough people who are about to buy the market exactly here, and this is why the market automatically will react like this. Okay, so not even the other institutions are aware right now about the situation. The only thing what they know is that price is here currently at a supply zone, for example, at a level where potentially the liquidity will be given, otherwise they will not test it. Okay, and bank will never do it for no reason. The bank is doing it because they know exactly, okay, we got here structural points, or we are already above structural points, or we have here triple tops and stuff like that. So we would like to test it here because the chance to have liquidity here is super high. Let's continue. And price is moving, and this is where everything is going to start. Step number 3, the ST, also called as secondary test, and this is where we will really start putting some pressure on the market. We will open up here 2,000 lot short. So this is really interesting right now, because the goal with the third step is actually to break structure, to break here where the automatic reaction was, to go lower than that. Why? Because below this one thing here, you got liquidities. It's super simple. You see it right now, right? This is kind of your demand zone here, or actually we are pushing even lower than that. You got here your liquidity points, you got here your liquidity points, you probably have here your imbalance, your fair value gap, or you have here a demand zone based on a higher time frame perspective. The things right now, just to come back to the idea, is they are dropping the price here in order to break structure, in order to catch these breakout traders who are just sitting below these lows to attack it, and also all these sell stop traders, okay, who put their sell stop there, traders who are looking for this retest here, right? And then, oh yes, we are in profit, but the price actually is about to go up higher, right? And this is the whole thing. So with the ST, they're making this big pressure to bring the price all the way to the downside. And now, super important, what the market will do in the next step is, which is the SOV, big sign of weakness. This is how it is called. Step 4, we will not take shorts. I would say, yeah, but if our job is to actually bring the price to the downside. Yes, you are completely right. But we will open over here 2,000 of lots long position. So we will take here long. Why? Well, to manipulate the price, guys, to grab this liquidity, to not let the price dropping lower, because otherwise we would not collect enough liquidity. We would just lose it. I mean, yes, we would be in profit, everything would be good, but it would not be the maximum squeeze. Okay, we still have a lot of juice in that lemon, and we would like to get everything out of this lemon. So we are buying the market, and we're buying the market right through our previous levels. So we are at that moment in big profit on our long position, but in losses on the other ones. So the next step for us would be then at the UT, at the up thrust. Okay, this is probably a name that you've heard multiple times already. Now, in this step, we will join the market again and we will open a few lots again. Okay, so the next job is here to open up more positions. So here is where we can really open a lot. We can open 2,000 more lot or even 3,000. So it really depends on the situation then how much they can really do at the end. So these are the steps. So we have here we have here 2,000 of short position, and what we do is we bring the price all the way to the downside. And then here is something which the distribution can face, can be always different. We could just drop from here all the way to the downside, and we're just adding here and here and here more short positions to bring the price lower. Or we just see, okay, we do not have enough liquidity, so we will push it one more time to the upside, or we let it to push one more time to the upside. Why? Because we got here again automatic reaction, because we are right now here again, we broke structure, so we are again here bullish. Here people took again buy stops and stuff like that, so a lot of people have been trapped again over there as well. Right now we got the automatic reaction if there is not enough liquidity, and with the last not the last step, sorry, here with the sixth step, we will open again even more shorts. We will drop the price and from there lower, and then here LPSY, the last point of supply, we will drop it one more time, so we will add more short positions over there. And yeah, that's basically it. This is how it works. At the end we will have huge profits, but what we will have is actually the longs. Okay, so these longs from step number 4, we still have them. And what we will do is actually in the future we will bring the price back up, and we will mitigate that thing. Okay, so we will close it, and this is then also kind of our idea that we will wait after the creation of the UTAD, so the uptrust of the distribution, which is not necessary. Also the UT would be enough. So these two, one of these two will create here a break of structure. And this is where we are interested in joining the market. Okay, so we will look then for a supply zone. So let me just delete right now that thing, just to make it more clearly for you. So like I said already, one of these 2 points will make a break of structure, will lead into a break of structure, and the break of structure can be here, like in this example. So let me just use this example because it doesn't make for you sense. Price will then move up, and we will look over here for a supply zone. You can also look here for a supply zone. It will use then one of these supply zones to drop then afterwards lower, because also here you have some positions that they still have. Okay, so of course they're also buying here a little bit, but the majority of the liquidity, and this is the theory, SOV is the sign of weakness, and phase B, they bought it from here. So this is the first point where they added, and this one here could be the last point where they bought. So during this whole range, you have your buying positions left, and depending on how much they will mitigate, depending on how much pressure in the market is currently, they will then use this zone or this zone. Okay, so here everywhere there are buying position. Okay, till this UTAD, in this example, till this UTAD, you have your buying positions left, and the market will decide by themselves. So they will decide it then, okay, do we need to do it or not? Do we have currently any fundamental news, so we don't need to push the price that high, because otherwise we will lose the positions and stuff like that. And this will then at the end decide if the price will push it all the way back up or only till here. But of course we will use that knowledge always in combination with our other knowledge that we have. Okay, this is right now only the Wyckoff theory about the distribution phase. Now you know actually exactly how the institutions are acting. Okay, so they are never closing their positions. They will close them always at break even, or a little bit in loss, or a little bit in profit. Okay, only these options you have. Sometimes you will also see price never coming back to these zones. Why? This is because there is fundamental news, okay, which allows them to close it here. For example, everything, they're closing it here, or they are realizing everything. Okay, they're closing everything because they said, okay, we're done for the month, we're done for the year. I don't know how the targets of every specific institution is, and this is then always created individually by some institutions. Okay, and this is why you have some options, and this is actually also why you cannot always be right with your strategy, because how would you know, from where should you know when an institution is closing or buying? Because we have a ton of institutions, but this is where we need to view them as the composite man in order to make it for us much more easier to understand everything, because they will always react on the reactions of the previous institutions who created these phases, for example. Okay, so it's always the same. Okay, and this is how we should proceed, otherwise we cannot make money here. Okay, so hopefully you enjoyed this video, guys. Hopefully I could clarify a few things for you, that the Wyckoff theory makes a lot of sense for you. How we will adapt it, of course, you can view this kind of thing, so it doesn't need to be necessary exactly in this kind of formula like we have over here. This kind of pattern can be always a little bit different. The key is just that the price here is clearing both sides. Okay, so sellers and buyers are trapped within this distribution phase, and this is the only thing which is important for us. That's it, guys. So see you then in the next chapter.